Hi, I'm James Robinson, and this is my stock pick of the week. My goal is that every week I'll pick a stock that I think is undervalued, that's a very solid company, and tell you a little bit about why I think it's that kind of stock, why I think it's attractive. I'll do that every week and build a little portfolio of the stocks that I pick. We'll track their performance, and hopefully over time we'll build a community of people who appreciate my stock picks and people I can talk about stocks with. So, my criteria for what makes a great stock is really simple. I look for great companies that have a durable competitive advantage. Everything that I do is based on the teachings of Warren Buffett and Ben Graham and Manesh Prabhai and sort of all the super investors of Graham and Doddsville. It all starts with the book Security Analysis, which was written by Ben Graham and David Dodd. What I don't do is look for the next great thing. I love Tesla. I'd like to buy a Tesla car, but I don't think it's a great stock. I'm sure there's a solar company or self-driving car company or super duper gadget company, all of which would be spectacular investments that would make me turn $10,000 into a billionaire. But I don't know how to find those stocks, and so I'm not trying. I'm looking for solid companies, everyday companies, that just kind of do the right things every day and create profits for the shareholders. The first stock we're going to pick to do a study on is called Altria. Many of you know Altria Group, symbol MO, as the Philip Morris Company. They changed their name in 2003. They're an American corporation and one of the largest producers and marketers of tobacco, cigarettes, and related products. They're based out of Richmond, Virginia. Altria was founded in 1847 when Bernard Morris opened a shop in London. In 1854, they started to manufacture cigarettes. Those cigarettes, called Philip Morris Ovals, were a non-filter brand of oval-shaped cigarettes which were continuously manufactured up until 2017. In 1902, an American division was founded, and in 1919, the company was purchased by George Whelan and turned into the Philip Morris Company. In 1970, they purchased Miller Brewing Company. In 1995, they bought General Foods and Kraft in 1988. In 2003, they changed the name to Altria. In 2007, they spun off Kraft to shareholders. In 2008, they split off Philip Morris International from the parent company. Just to give you a sense of scale, in 2010, they produced 146 billion cigarettes. There's a lot of Philip Morris brands that you probably don't know of Philip Morris. Nat Sherman is a maker of cigars. Obviously, Philip Morris you know, but they make Marlboro, Virginia Slims, Skoal, Copenhagen. They have a wine division. There's a lot of products that are out there that are produced by this company that you don't know are produced by this company. As of February 1, 2019, the company had a market cap of $92.44 billion, revenues of $19.56 billion, profits of $10.2 billion. The PE ratio is 8.74, the yield was 6.48%, and the company had debt of $13.9 billion. So when I analyze a company, I look at 29 financially, statistically trackable areas. That's not the same thing as saying, do I like this company as a tobacco company, or do I think this company has a durable competitive advantage? What I'm doing here is looking at the numbers and trying to figure out if I think the numbers for this company are solid. So we look at 29 different areas. 9 of those areas are operating related areas, and we'll talk more and more about those items, not just in this analysis, but future company analysis. 10 of the areas are financial, and what I mean by financial is really how do they handle debt. And the third area is management, and what I mean by management is how well a job is the company doing in terms of using the assets of the corporation, whether through return on investment or return on equity, and how well they're doing at returning profits to the shareholders, whether that's in the form of reducing debt, buying back stock, paying dividends, or investing the money well through efficient use of retained earnings. So you can see here that Altria had a very high rating. I rate each position on a scale of 1 to 4, 4 being the highest, just like a GPA for school, 3 being above average, 2 being average, and 1 being below average. Almost every category for Altria is a 3 or a 4, with the possible exception of cash and debt. I'm going to talk more about that later, but I think there's some good reasons to ignore that in the case of Altria. About 5% of the companies, 5 to 10% of the companies that I look at will have a total grade of higher than 3.0, and Altria's total GPA is 3.34, so it's significantly higher. It's one of the really, really solid companies. The very first category I look at when analyzing a company is gross margins. Gross margins represent the percent of total sales that the company has to spend on cost of goods sold. So, for example, if a company makes $100 but has to spend $50 of that money on the cost to produce its product, then there'd be $50 left over and they'd have gross margins of 50%. The equation for gross margins is the revenue minus the cost of goods sold. That number is then divided by the revenues. When I'm analyzing a company, I'm looking for companies that have a very strong, durable competitive advantage. And by looking at gross margins, I can very quickly discern four things about a company. First, I can determine if it's a commodity business or if it has a competitive advantage. The reason is that a commodity company tends to have lower margins than a company that has an advantage and is thus able to charge higher prices for its product. Second, I get to determine how durable that advantage is by looking at the margins over time. Next, I look at how sustainable the margins are by how much they're changing, going up or down over time. And finally, when I look at a company's gross margins, I get to determine how much room the company has for error or for competition. If a company has very high margins, then when they make mistakes, there'll still be money left over to handle those mistakes. If a company has very, very small margins, then when a mistake happens, that'll almost always put them into a loss, and because they just don't have any room for error. There's several different broad categories of companies. One of those broad categories is a commodity business. So imagine an oil company. An oil company doesn't get to decide how much it's going to charge for its oil. They charge what the market will bear. That fluctuates really with supply and demand. If there's too much oil being produced, their prices drop, and therefore so do their profits. If there's not enough oil being produced, then of course their profits will go up. The problem is the business doesn't get to control that. You're at the whim of the market. And the problem with that is that over time, commodity businesses tend to make less and less money because there are more and more people in the market producing that product. That's one of the reasons why I really don't like commodity companies. I like companies with durable competitive advantages. And that is generally decided by or determined by companies that have significant margins. So the first thing I look at when determining gross margins is this margin high enough to convince me that this is probably a company that has some control over its pricing and thus has this competitive durable advantage, which I'm going to talk about over and over again. The next thing I tend to look at is I'm looking for durability. Are the margins sustainable? If the company's margins tend to be relatively flat, solid but relatively flat, that probably means they have a competitive durable advantage. If they tend to be eroding, those margins are getting smaller and smaller over time, that means the competition is coming into the market and it is making it harder and harder for the company to compete on, and so they have to compete on price. So I'm looking for companies that are able to sustain or hopefully even gradually marginally increase their gross margins. Consider another type of company. Consider a grocery store. Grocery stores have very, very small margins. They do tremendous amounts of sales, but they have very, very small margins. But what happens when the company does something wrong? They're involved in a lawsuit, or they're overpaying for rent, or there's a labor strike. All of these things happen. The company has very small margins, so there's very little margin for error. When something bad happens, it really dramatically affects the profitability of the company. Oftentimes, the company didn't really do anything wrong. It was just the market happening. But they have no safety valve. They have no margin for error. So I look at a significant gross margins, or above average gross margins, as a way to buy me a buffer for those inevitable times when things don't go well with the company. So here you see the gross margins for Altria from 1997 till 2017. Several things that I want you to look at because a lot of these things are common to a lot of the charts that I'm going to be doing. First of all, I've analyzed over 800 companies. So I've looked at what the top 10% of companies have had in terms of gross margins, and you can see that here it's about 70%. If you have 70% margins, you're a fantastic company in terms of gross margins. The next line is companies in the top 25%, that's the turquoise line. The next line down is the green line. That's a desirable gross margin. I really like companies that have gross margins above that number. The next number, which is the red one, is sort of the minimum gross margins that I'll really consider a company over time. And then the fourth one, the last line I should say, is orange, which is, in this case, the bottom 10%. I just like to know if this company is really, really bad in a category. So the blue line shows me the gross margins for Altria over time. And you can see that with the exception of 3 years, Altria's gross margins have always been above my minimum line. You can see that they've always been a relatively narrow swath. They really, gross margins picked up a little bit in 2006 and 7. And then they dropped dramatically in 2009, which was the recession. but then they've gradually been increasing and building back up to the number that they've been at historically from 2009 to 2017. And you can see, in fact, that number has been a gradual increase every year. That tells me a bunch of things. It tells me, first of all, because it's over my minimum desirable gross margins, that the company has solid gross margins. Secondly, you can see that it's a durable advantage because they've had it over a very long period of time, through recessions, through boom periods. Third, you can see that there's no erosion in their competitive advantage because, in fact, their margins are increasing over time. So I look at this as sort of an ideal example of gross margins for a company that I'm considering investing in. The next thing that I'm looking at is net earnings as a percentage of revenue. So this is simply for every dollar of revenue they create, how many dollars of actual profit to the shareholders are being created. And you can see we're using the same exact things. We're looking at the top 10% of companies, top 25% of companies, bottom 25% and the bottom 10%. And you can see that Altria has always been a significantly well-run company. It's really always been in the top 25% of producers. And in some years, it's been significantly above that. But more importantly, again, from 2010, that number's been increasing. The last couple of years, it increased dramatically. I almost discount that because it's so out of the norm. But what I do like is that the trend is that this company has significant earning capability based on its net income to revenue dollars. The next thing that I look at is earnings per share, in this case, diluted shares. The red line represents break even. That means you didn't make any money, but you didn't lose any money. Oftentimes when I look at stocks, you'd be amazed how often their net earnings are negative. But you can see that the number from 2008, which again was the middle of a recession, to 2016 has gone up. It's gone up for a number of factors. It's gone up because the company's made more money. It's also gone up because the company has bought back shares. And when you buy back shares, the same number of profit is being divided by fewer shares, so the profit per share goes up. But again, you can see that there's this nice gradual increase in earnings over time. I like that. That means that I'm going to make more money off my investment year in and year out. Let's talk about SG&A. SG&A is the acronym for Selling, General, and Administrative Costs. SG&A are expenses that are incurred to promote, sell, and deliver a company's products and services, or to manage the overall company. So examples of SG&A include sales commissions, advertising, promotional materials, compensation for the company's executives, as well as marketing, sales, finance, and office staff. The rents, utilities, supplies, computers, etc. that are used outside of the manufacturing function. So why do I care about these costs, right? Why is SG&A so important to me? To me, this is a tax on profits. There are 4 areas that a company can have a tax on its profits that can destroy otherwise fantastic margins. Those areas are SG&A, R&D or research and development, plants and equipment, and inventory. All 4 of those areas are things that happen after the products are produced that can cost money. They're variable. Some companies have significantly high costs. For example, pharmaceutical companies have really high R&D costs, and some companies have significantly high inventory costs. They have to tie up a bunch of money in inventory, and if the inventory goes bad, for example, a new product comes out, the inventory is wasted. So I like to be aware of how these 4 taxes play for the companies that I'm interested in, as an idea of where I might be hemorrhaging money or where the company's doing a fantastic job of controlling costs. So here you can see 2 charts. The bottom chart is R&D to gross profits. Again, you can look at R&D to gross profits based on what companies are doing. You can see that about 50% of companies have no R&D costs, and Altria is one of those costs. So that obviously is very attractive. There are companies that have R&D costs that are 30% of gross revenues. That's obviously significantly less attractive. We're going to talk more about R&D in other picks, but just for now, understand that R&D for Altria is effectively 0, and that's very, very strong. The other thing we're looking at here is selling, general, administrative. So if you look at the top 10% of companies for SG&A, you can see that they're about 20% of their gross profits are SG&A. The worst companies have about 90% of their profits used for SG&A. So we like to keep track of that. You can see that the range is very, very large here. The good news for Altria is that it has gotten better and better. It's been in the top 25% of companies since 2006. It continues to improve, and it now is in the top 10% of companies, and the trend has been going in the right direction. So you can see here, R&D is extremely good, and SG&A is good and getting better. So moving on to financial issues with Altria, you can see here a chart of the company's debt. You can see that in about 2006, the debt peaked and has been declining pretty dramatically. A lot of that decline had to do with the sale of Kraft, where they spun that off to the shareholders and they got rid of a bunch of debt. But basically, the company's debt has been completely constant since 2007. You can see that the total current liabilities have been constant. Long-term debt has been constant. For those of you who are unaware, total current liabilities are debt which is due in the next 12 months, and long-term debt is debt which is due 12 months or longer into the future. So you can see both these numbers have been very constant. I think the reason that it's been constant is simply that interest rates are so low, it doesn't make much sense to pay off this debt, and so they've continued to carry it on the books. My hope is that as interest rates start to rise, we'll see these debt numbers decrease, but for now, I'm totally comfortable with them. So one of the key things that I like to look at when I'm looking at a company is how long would it take to pay off the debt if they decided to make that a concerted effort. And you can see here that if a company takes 10 years or longer to pay off its debt, that means it just has too much debt in my mind. If a company takes 4 years or less to pay off its debt, then I think that's a solid company that has a manageable level of debt. And you can see that some of this, even though the debt has remained constant on the last slide I showed you, you can see here that years to pay off debt has decreased. That's simply because they've been making more money every year. So the debt has remained constant, they make more money, and therefore it takes less and less time. So effectively, they could pay off their debt in a year or two if they really wanted to. The debt's very manageable for this company, and so it makes it really easy to recommend Altria. So let's talk about current assets to current liabilities. For Altria, this is an area that I gave the company a failing grade. However, when you look at these numbers, you can't look at them in a vacuum. You have to look at them in context. So for background, current liabilities are the total amount of money that you have to pay this year to people. Current assets is the amount of cash and securities you have on hand and receivables which are liquidatable within a year. So effectively, those two numbers should offset each other, right? Your current assets should be able to more than pay your current liabilities, typically with some kind of significant buffer. With Altria, that's not the case. With Altria, their current assets are often lower than their current liabilities. And so you give this company a failing grade for that. However, there's a couple of things to think about. Altria is a company with very stable revenues, very stable profits. They are quarterly, quarter after quarter after quarter, sort of banging out the same sorts of numbers. And so they're simply able to budget that they'll be able to pay their current liabilities through operations and through profits rather than paying them through cash on hand. And because they've been doing that since 2007 and they're so stable and their product is something that we all know is addictive and people aren't going to quit using en masse, I think it's a reasonably safe strategy, which also dovetails with debt to equity. So again, you'd like to see a company that has significantly more equity than debt, or at least the debt is some significant multiple of equity. So if you look at this slide, you can see that the blue is the debt to equity ratio for Altria. And again, so we're looking at how many dollars of debt do you have for every dollar of equity. And you can see, for example, a company in the top 25% has, maybe 1 times debt to equity. And Altria is north of that. They're somewhere between the bottom 25% and the top 25%. So again, this is an area where you'd say, well, this is a problem. But what you have to do is, again, look at the numbers in context. And later you're going to see that Altria pays a tremendous amount of money out in dividends. They spend a tremendous amount of money buying back their stock. They're simply not interested in retaining a bunch of earnings and creating a bunch of stockholder equity. The benefit to that is they get tremendous returns on the equity they do possess. The additional benefit is that the stockholders continue to be enriched by owning a larger percentage of the company every year as shareholders are reduced, and also by getting significant dividends. So there's sort of a trade-off there. And because I understand the company and because I understand what they're doing with the company, I'm not really that bothered by either the current assets to current liabilities or the debt to equity ratio. But I did want you to understand that I've considered it and thought about it, and I haven't overlooked it. So here you can see dividends and shares outstanding. So one of the important things when looking at a company is, what are they doing with all those profits? If a company retains all its profits, then they have to be able to demonstrate in the long run that they're using those profits intelligently. And we'll talk about how you can do that in future picks. But for now, Altria is not a company which is retaining very many earnings. And you can see that from looking at this chart. First of all, since 2008, the dividends have gone up every year. And that's total dividends. That's not dividends per share, which have gone up at an even faster rate, because if you look at the next slide, you can see that in 1997, this company had, it looks like 2,500, but that's 1 million. So it's 2.5 billion shares outstanding, and now they're down to 1.875 billion shares outstanding. So that's about a 25% reduction in the number of shares outstanding, which simply means if their earnings had been flat, their earnings would actually be, per share would be 25% higher. So we like companies that buy back stock. We like companies that pay dividends. And so again, this is something, this is the explanation for the slide before it, in which we had very low debt to equity ratio. So here we see a chart of Altria's dividends. You can see that they basically have gone in an upward trend. They dropped a little bit from 2004 to 2008, but part of that was the recession, and part of that was that they sold General Foods Kraft. So there was an adjustment because they were a smaller business. But since 2008, they've gone up every year. And so you look at this and on the face of it, you say, wow, this is a pretty good company in terms of dividends. But that doesn't really tell the whole story. So I look at dividends in a little bit more thorough way. When I look at dividends, I look at four factors. I look at the yield and growth, so how much are you making and how much is that going up? I look at dividend safety in the context of earnings. So is the company making enough money to support the dividends it's paying? I look at dividend safety in the context of cash flow, which some people think is a more effective way of looking at this number than looking at it through earnings. And the final thing I look at is dividend safety in the context of its current debt load. So as interest rates change, will the company continue to be able to pay dividends? And when you look at those things, while Altria is a solid company, I'm not sure its dividends are as rock solid as you might at first think. So first, let's look at yield and growth. The yield for Altria is 6.48%. This is excellent. This is amongst the best solid companies you're going to find, and is in and of itself a reason to buy this company. It's even more reason to buy this company. You look at the average dividend growth for the last 5 years has been 8.3%. So you get a great yield, and then that yield grows at a rate of 2 or 3 times inflation. That's pretty solid. You can see that here. The blue is the amount of dividends that have gone up every year, and the orange columns are the interest rates, and it looks like they're going down, but they really go down from about 8.7% annual increases to about 8.1% annual increases. It's very solid every year. The second area that I look at in terms of analyzing a company's dividends is the payout ratio in relation to earnings. Effectively, is the company earning enough money to continue to pay out the dividends that they're paying now, or are they robbing Peter to pay Paul, as it were? You can see here that Altria's the last year, Altria had a payout ratio of about 32%. That's really good, no problem at all. But it is artificially low because they had kind of a great year last year. Over the last 5 years, the payout ratio has been 71% on average. That's a little bit high. It's not exactly a red light, but it's certainly not a green light. It's the kind of thing you keep an eye on as you're analyzing the stock. So let's talk about dividend safety in the context of cash flow. So the dividend payout free cash flow is 95%. That means that almost 100% of the free cash flow is going to pay dividends. That's too high. Average payout ratio in the last 5 years is 91.8%. Again, that's too high. So let's talk a little bit about how these numbers are calculated. So cash flow is money that's coming in, actual money that comes into the bank through operating activities. In 2017 was $5 billion. Then you subtract from that the capital expenditures. That's money that you spend to upkeep your equipment, your factories, things like that. It was about $200 million, so really pretty de minimis. So that gives you a free cash flow of $4.856 billion. The dividends they paid out last year was $4.8 billion, so that's 95% of cash flow to dividends. That number again is too high. I realize what they're doing, and I realize their company is very confident that they're going to continue to have earnings and earnings growth year in and year out, but sooner or later something's going to go wrong. And this is a company which I'm not sure will be able to continue to increase its dividend year after year through the rough times. And if you remember, when you look back at the slide that we showed you about the dividends, you can see that in the recession they did cut back a little bit. So I just think as you're looking at the stock, you want to keep this in mind. Now, I'm not suggesting this is a bad stock, and I'm not suggesting this is a reason to disqualify this stock, but if I'm purely looking at the stock because I love the dividend, if that was the only reason to buy it, this would give me a real pause. It's not the only reason I'd buy it, but it is something that I think about. The last thing to look at is dividend safety in the context of its debt load. So in 2017, the debt load was $13 billion. That's long-term debt. They had interest of $692 million, and it equates to an interest rate of 5.31%. The problem is they're paying 5.31%. So if their interest rate was to go up even a little bit, they'd no longer be able to support this dividend. If the dividend was to go to 7% or go to 6%, if you look at this chart, you can see that that would create a reduction of $89 million in cash flow, which gets the new adjusted cash flow down to $4.7 billion, which is not enough to cover the current which is not enough to cover the current dividend. So there's very little room to give here on cash flow, there's very little room to give here in terms of earnings, and there's very little room to give here in terms of interest rates for the company to continue to pay the dividend it's paying. So I look at this dividend as being suspect and would not in and of itself be a reason to buy the company. So I showed you in an earlier slide that the current assets and current liabilities and the debt to equity ratios for Altria were both very poor. And one of the reasons for that is because they're returning so much money to shareholders. They're not retaining a lot of earnings and they're not keeping a lot of equity on hand. This slide, return on shareholders' equity, shows you the benefit of that, right? We like companies that need a little bit of money to run their operation and are able to spin off a lot of profits off of that. And you can see here that Altria is a fantastic company, always in the top 10% of companies of the 800 companies that I've looked at, all different kinds of companies. And so this is the slide which allows me to forgive them for their current assets to current liabilities and their debt to equity ratio. So let's review a little bit. When I'm looking for a company, ideally I'd like to find a monopoly, right? A monopoly is something where they are the only people selling their particular good and product. Power companies are perhaps the best example of a monopoly, or maybe a toll bridge. But those companies don't exist, and when they don't exist very often, and when they do exist, they're typically not unregulated, and therefore their profits are controlled. But Warren Buffett has this concept of a consumer monopoly. That's a company that doesn't really have a monopoly, but they have one in the consumer's mind. So for example, if you were to think about chewing gum, you almost certainly are going to buy a Wrigley chewing gum. There's no real difference between Wrigley chewing gum and some other brands, but you have a loyalty to it. Coca-Cola has another loyalty, consumer monopoly, along with Pepsi. You're more likely to buy those two products than Shasta, for example. And so you'd like to find these companies because when they have these monopolies, they have real pricing power. So the question is, the first question is, does Altria have some sort of consumer monopoly? And I think it's very fair to say it does. It is a consumer monopoly on two fronts. First of all, it seems that their product is addictive. That means people can continue to use it. At this point, I don't care that it represents a health problem, because there are lots of things that represent health problems, you know, alcohol, for example. People like them, they improve their people's quality of life, and they're willing to take those risks. It's not my job to tell people what they should or shouldn't do. But there is this addictive component which makes people think that, which makes people want the product. Secondly, there is brand loyalty. If you take a Marlboro person or a Copenhagen person and try to convince them to move to a different brand, it's very difficult to do. And so there is this real consumer monopoly aspect to Altria's products. Does the company have pricing power? It would seem that they do. They seem to, my understanding is that they raise the prices of their cigarettes at least annually, if not quarterly, and they don't seem to have any reduction in demand. And what demand there is probably not related to price. It's probably related to people wanting to live healthier. Another interesting aspect about Altria is they're extremely heavily taxed. A significant portion of the costs for someone to buy a cigarette is taxes, and yet the company continues to make money. The next one is, does the company have a reasonable level of debt? And the answer is yes and no. I'd prefer to see no debt. I think this company could certainly justify paying off its debt. But the debt level has been stable. Interest rates are very, very low, and I think they just have a disincentive to pay off their debt. They're much happier to give that money to shareholders, and as a shareholder, I don't really disagree with that very much. Next thing is, does the company own its shareholders? And this, the answer is very strongly yes. They pay a very strong dividend, and they pay a rising dividend. They buy back stock at a sensible clip, and they retain a reasonable amount of their profits, and they generate an excellent return on equity. So from a management point of view, a stockholder's point of view, this is an excellent company. So would I buy the stock? Yeah, at this price I absolutely would. And if this price is, in the neighborhood of $48 a share, depending on when you see this video, but if it's in that price range and nothing has changed significantly, then I think this is a great company. So if I'm going to be giving you stock tips and advice on what I think you should be buying, I think we should be tracking those so we can really keep me honest and see what my results are. So this last slide is the first entry. Every week I'll add new stocks to it. I'm going to take $10,000 for every stock I suggest that you should buy at the date, the price on the date that I tell you to buy it. And we'll keep track of it, see how it goes, see how much we make in stocks going up or going down, dividends, the whole deal. And we'll look back on it in a year, and my goal is that a year from now I'll have beat the S&P 500, hopefully by a significant margin. If I'm able to do that, then I would suggest maybe keep following my advice, and if I'm not able to do it, well then go buy an ETF.